All right, we can get started here.
Okay, welcome everyone. I'm Elisabeth Olson.
And I'm Aubrey Coleman. We are certified financial planners located in Fort Collins, Colorado, and we work often with people in the tech industry and with equity compensation. And so we wanted to share some of the questions and things that we get.
Sometimes companies will include company stock as part of your total compensation package, which is awesome.
So we're going to go over a brief overview of the different kinds of stock compensation we see in our practice. And after we outline those, we'll do a deeper dive into stock options, and then we'll answer some of your questions. So if you have a question, please use the chat feature and we'll add it to our list to answer at the end. We've also gathered some questions that we get asked to answer as well. So, all right.
So step number one is to know what you have. Because there's different ways that a company might compensate you with their stock. So the first one is they could just compensate you with stock. It's direct, it's taxable, just like if it was your pay. Secondly, they can compensate you with stock, but within your retirement plan, like your 401k. Third, they can give you what's called restricted stock units, RSUs. Next, you might be part of an employee stock ownership plan, also called an ESOP. And then lastly, there's incentive stock options and non-qualified stock options. And that's what we're going to be talking about today, those two things. Incentive stock options, ISOs, and non-qualified stock options, NSOs.
And that's actually not a complete list, but the fact remains, your first step in understanding your options is to know what you have.
Okay, great. So today we're going to be talking about, like I said, those two categories, incentive stock options and non-qualified stock options.
And both incentive stock options and non-qualified stock options are options to buy company stock at a certain price, usually below the market price.
So with options, you don't have to buy the stock that you're being offered. It's a choice, an option.
But if you do, there could be tax consequences at 2 points on your option journey. And before we get to those 2 points, let's go over some of the language.
Okay, get your pencils out. So first, there's the date that you're granted or awarded or given the options by your employer. So grant, that's your first term you want to know. And you often have to hold those granted shares for a year before you can do anything with them. So the end of that holding period is called the vesting date. That's your second term. And that vesting date is the earliest date that you're allowed to, third term, exercise your options. Exercising your options is that third term. And if you exercise your option, that simply means that you buy the stock offered at that favorable price that the company is letting you buy it for. Next, there's the date that you sell your stock, which is different usually than the exercise date. And then finally, there's the expiration date of your granted options. If you don't make a decision, that grant will expire. And that time period between grant and expiration is usually 10 years. However, if you leave your employer with vested options, you have to exercise those options within 90 days of leaving. They're not going to give you that whole 10 years if you leave the company before then.
All right, so now that you have some of the vocabulary, let's look at the tax consequences at exercise and at sale. There are no tax consequences at grant, vesting, or expiration.
Okay, so this is where ISOs and NSOs differ. So we're going to look at NSOs first, how those are taxed, non-qualified stock options. So let's say XYZ company gives you the option to buy 5,000 shares of stock this year at a price of $100 a share. The total cost to you would be $500,000. Now, on the day you exercise your option, XYZ is selling for $150 a share for a total of $750,000. In other words, someone off the street wants to buy XYZ stock, the same number of shares, they're going to be paying $750,000. So what's happening here is that XYZ is giving you $250,000 by letting you buy their stock at that below market price. And that $250,000 difference will be reported on your W-2 as ordinary income. So this income is considered earned income and is subject to FICA.
All right, so second, there's the consequence when you sell your XYZ stock. The tax treatment depends on how long you wait to sell. You could sell it right away. If you exercise and sell in one transaction, this next consequence doesn't occur. Let's say you buy XYZ for $500,000 and sell it the next day. And in that one day, the stock surged and it's now worth $800,000. The difference between $800,000, the value the next day, and the value on the day you exercised your option is $50,000. Because you sold it after owning it for less than a year, that $50,000 of gain would be taxed at short-term capital gains rates, which are the same as ordinary income tax rates.
And ordinary income rates are generally high. But if it's just $50,000, that might not make that much difference in your overall tax bill, right?
So you could choose to hold on to that stock for 366 days, more than a year. In a year, maybe your stock is worth $1 million. So $1 million minus $750,000 equals a difference of $250,000 of gain. And because you waited 366 days, that $250,000 of gain will be taxed at long-term capital gains rates, which are generally lower than short-term capital gains rates.
Man, those are some serious numbers. You can see how planning how and when to exercise and then when to sell your stock is critical.
Okay, so that was kind of an overview of non-qualified stock options. We're going to switch over to incentive stock options, ISOs, and they're much like NSOs with some key differences. So here are the main ones.
All right, first there's a limit on the value of your options that can be treated as ISOs. So ISOs generally are taxed more favorably, and so the IRS, right now that cap, Aubrey's going to talk about that cap.
Yeah, the fair market value of ISOs that is exercisable for the first time in any calendar year may not exceed $100,000 based on the fair market value at the time of grant. So any excess over that $100,000 will be treated as an NSO. And secondly, when you exercise ISOs, you do not owe ordinary income tax. So instead, you report an AMT adjustment when you exercise your options. In the above example that we were talking about, only a part of that $250,000 difference would be treated in the more favorable ISO manner. You might have to pay some alternative minimum tax, AMT, but it would generally be less than it would be if these options had been non-qualified. So another difference is that with ISOs, you have to hold them for 2 years from the grant date in order for the gains to be taxed at long-term capital gains rates. So there's 2 clocks running with ISOs, the 2 years from grant date clock, and then the 1 year from exercise date clock. So that's our brief overview of stock compensation with a deeper look at NSOs and ISOs, and their options are an amazing way to benefit from the long hours you put in at your company. And so it's important to understand them and plan for when you exercise your options and sell your stock. So we're going to turn it over to time for questions. So we've got some already queued up here, and add yours if you have more.
Awesome. Okay, so the first question is, how are RSUs taxed differently from stock options?
Yeah, so RSUs are granted on one date and vested at a future date. They're taxed once they're vested. So stock options are taxed in some form at exercise and again when you sell your shares of stock.
So it sounds like RSUs are simpler.
They are simpler.
Right.
All right. Where do you find the cash to afford to exercise options? Because they're a buy of stock, right?
Right. Can be expensive. Yeah, it's a good question because, yeah, in our above example, to exercise the XYZ stock, it was going to be $500,000, and most of us don't have that kind of money sitting around. So that's a really good question. But the good news is, if your company is publicly traded, you might be able to exercise and sell in the same transaction. In other words, you don't have to come up with any cash. And then some employees will borrow to exercise their options. Because why? They believe their stock's value will hold or increase and more than make up for the interest that they pay to borrow those funds. All right, here's a question. Can I give away my options?
Okay, so there's two considerations. One, does the IRS allow it? And two, does the company allow it? With ISOs, the answer is almost never. With NSOs, sometimes the IRS will allow it, but usually the company doesn't.
So maybe start with the company then.
Yeah.
All right. So
let's see. How should I adjust my stock option strategy in a volatile market?
Yeah, that's a great question for this year because we've had plenty of uncertainty in the market. And we actually like volatility for both exercising options and selling the company stock. Because if you exercise when the price of the stock is low, your first tax bill will be lower. And if you sell when the price of the stock is low, then your second tax bill will also be lower. And, the counter argument to that is, well, you generally want to sell high and buy low. So I would say the volatility comes to play in that if the stock is the price of the stock is low, you sell low and buy something else low, and then it comes back up. Yeah. Okay, here's our next question. Should I hold my company's stock longer for future growth or sell the shares for stability's sake?
All right, so with options, there are two decisions. One is when to exercise and the other is when to sell. And we like exercising options early. It's kind of our maybe default that we would look at, partly because we often see employees granted more and more stock options the longer they work for the company. And, generally speaking, we like exercising them as that becomes possible. And remember that the difference between the exercise price and the market value on the date of exercise is taxed at high ordinary income rates, whereas long-term gains are taxed at more favorable long-term capital gains rates. So if the value of the stock is increasing, you want to shift how that increase is being taxed to the more favorable tax rate. And we like selling the stock to diversify one's portfolio because you're working at this company, you're already dependent on them for your livelihood. We've seen big solid companies go bankrupt, leaving employees without jobs and without their pension and with worthless stock. So we don't like our clients to have so many eggs in one basket.
Okay, so what is the advantage of exercising stock options early versus later?
So we like exercising early, partly because we often see employees granted more stock options the longer they work for the company, like I said earlier, and we like selling to diversify one's portfolio. But there's also times when waiting makes sense. So sometimes it makes sense to clump your exercising of options. You're going to hit the highest tax bracket and be subject to AMT, and so you just rip the Band-Aid off and do it all in 1 year.
Okay, and what happens if I don't exercise my options before the expiration date?
You snooze, you lose. So the option, the choice to buy stock at that exercise price simply goes away. All right. What happens to my stock options if I leave the company before they vest?
Well, in a nutshell, you lose them. Okay, but just to kind of give you an overview of how this works, what we often see is a 4-year vesting schedule with a 1-year cliff. So once you reach that 1-year cliff, 1/4 of the options you were granted at hiring become vested, meaning you could exercise 1/4 of them at the end of that, at that 1-year cliff. So once you reach the cliff, you start vesting additional shares each month. So then if you leave the company, you often have a period of 90 days to exercise any options that are vested.
All right. So just checking to see if we have any more questions. All right. So stock compensation can be a really powerful tool, but you really want to have a strategy in place. As certified financial planners, our mission is to help professionals like you navigate these decisions with confidence and clarity and purpose.
And ideally, we want to help you keep more of what you've earned and pay the least amount of taxes. But in order to do those two things, because sometimes they're in tension, right? You need a plan to look at all the different things that are going on. So like we said in the beginning, we work with a lot of clients that have stock compensation, and answering these questions, if you're interested, then just follow the link in the chat or in that follow-up email that you'll get. And you're amazing, and keep up the good work, and we can't wait to meet you.